Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets, and analyse the issues impacting the Kiwi economy. Let's get into it. Okay, welcome back to Markets, Mystics and Mayhem, back for another episode. Now, I know it's 2025 and we want to get rid of, stop thinking about 2024. It was a really tough year for many people, but we did just get the latest GDP numbers for the December quarter, which is basically our economic report card. And actually, the New Zealand economy performed pretty well toward the end of last year. So we'll go through those numbers and see exactly what industries were kind of the stellar performers there. But this data is almost 3 months old. So we would like to look more into those sort of more timely data that gives us, a better gauge as to what's happening for the New Zealand economy going ahead. And actually looking at that data gives quite, promising data for a turnaround in economic activity this year. So that's what today's episode will be about. Sabrina, you were in the lockup for the GDP this time. How was it? What did you make of the numbers?
Yeah, I mean, it was pretty good. I went in and we went into it, expecting a bit of a rebound in the economy to end the year. I think we went in with a 0.3% forecast over the quarter, and we were pretty pleasantly surprised because the economy actually expanded 0.7% over the quarter. So quite a bit stronger than our forecast, the Reserve Bank's forecast, and even market consensus. There was a bit of a technical driver that sort of maybe pushed the number a bit higher than you would sort of expect. But if you also look at the industries, there were some really strong green shoots emerging. So, for example, the services had surprising strength over the end of the year.
Yeah, I guess, before we jump into those industries, that 0.7, as you say, was really strong, partly due to some technical issues because this data, it's been subject to some pretty big revisions in the past, right? And that 0.7 actually does follow big declines over the last two quarters before that. Why don't you talk us through that?
Yeah, so we actually went through a cumulative 2.2% recession in the 6 months prior to the December quarter. What we saw from that sort of move and talking about the revisions is there's been a lot of volatility, as you say, in these GDP numbers since COVID, because of these big sort of sways that we saw in the COVID activity periods, and also because we lost tourism as a whole, right, when the borders were shut. And tourism was quite a seasonal sort of component that we had. So there's been a bit of technical issues trying to address the seasonal components of GDP. And that's why we've kind of seen a bit of volatility in the numbers. I think, we were previously, before these revisions, we were seeing like one quarter we'd have some positives and then some small dips. And then all of a sudden the revisions meant that we were getting
a really big decline in economic activity, right?
Yeah, that's
basically
huge.
A snowballing in 2024,
yeah,
right?
Yeah, we basically started from a higher point, but then the contractions actually just deepened from the second half of last year.
Yeah. And that 2.2 cumulative contraction in those 6 months is the deepest since
excluding COVID.
Yeah.
It's the deepest since 1991.
Yeah.
And then if you look at things on a per capita basis, which I know we're going to talk about later, but that recession we had there was the weakest we've had, even I think it's weaker even than the GFC.
Yeah. Okay, so big declines in 2024, but ended on a slightly positive note. As you were saying, there was some genuine growth in there in the industry basis. What were the industries that kind of led that recovery over the quarter?
Yeah, so quite a few actually, because if you look at the overall print, 11 of the 16 industries actually posted lifts over the quarter. But if we're looking at the main drivers, there was a particular strength in our services, specifically anything that had to do with sort of tourism-related activity. So I believe the main driver was your rental hiring and sort of real estate, and then also your retail, trade and accommodation. So kind of like we talked about in our last episode, which if you haven't watched, just plugging it, we talked a bit about how tourism levels have sort of started to edge higher or creep higher into sort of pre-COVID levels. We're now at around 96% of pre-COVID levels. And what we actually saw was that we saw a lot of higher spending over the December quarter from these tourists as well, which really boosted activity across retail, trade and accommodation and the rental and sort of hiring space, and also categories like your transport and your arts and recreation also surprised us on the upside.
I think this is something that we've been waiting for quite a long time. Since coming out of COVID, we've always said, well, the December quarter, kind of March quarter, it's the peak time for international tourism. It's our summer months. People come here during that time. And since COVID, we've really been waiting for that boost led by tourists to come. And ever since COVID, it hasn't really been. But I think this is the quarter that we actually saw those increases in activity, that lift in activity driven by tourist spending, right?
Yeah, 100%.
And so actually, I think now tourism is actually back to pre-COVID, maybe even slightly surpassed pre-COVID levels. So that's really good news.
Yeah, and what we saw was our travel exports. Our export services were up 8%.
Yeah.
Around 8, not 8.5, right? 8?
About 8%.
About 8%. So yeah, you're really seeing that that's coming from your tourism levels actually coming back to sort of pre-COVID levels, which is great.
Yeah, that's really that one sector of the economy, as we said in the previous episode, that hasn't quite recovered, but I think we are seeing that return to full strength.
And speaking of the prior episode, because another industry that did pretty well, and we've kind of already covered it in the last episode, was the primary sector, and mainly that agricultural sort of lift, that higher dairy and meat prices really did see sort of a lift in activity there. That's still performing well. Wasn't the main driver, but it's good to see that activity is still pushing on.
So agriculture was up on the quarter as well?
Yeah, agriculture.
Okay, so those are, well, it wasn't all one way though, was it? Some industries, some industries actually declined in output, didn't they?
Yeah, so like I said, 11 of the 16, the 5 that didn't contribute to growth were pretty somber, particularly construction, didn't do well. We saw a 3.1% decline over the quarter, which really take that in, 3.1% decline over the quarter alone. And we've had, I don't know how many quarters of consecutive declines there, but all up over the year, construction is actually down 10.8%, which I think, again, excluding COVID, I don't think we've seen a decline like that in the past 20 years. Not really a surprise if you think about the landscape, and also if you look at the indicator data. We know that the housing market's still struggling and construction costs are still running high. So not a surprise in that sense, but it still doesn't take away the sting of that fall. But hopeful, with rates moving lower as well, that we are hopefully nearing sort of a bottom for the construction industry. And, as the housing market picks up, we could see a bit of a lift in activity there.
Yeah, we're keeping a close eye on those building consents to see if there's that lift in activity. Obviously, it's very dependent on the housing market picking up as well. Once there's demand there'll be demand to start building again, and we'll see that activity pick up. But for now, no real signs of life just yet.
Nah, still flatlining.
Yeah. So December quarter up 0.7%, so slightly better.
No, I was just going to add in one more thing.
Okay, continue.
Because I think we're moving on to the per capita stuff, maybe. Annual. But before we go on to that, another area that we should probably flag that didn't do so well was sort of, if you look at the professional services, so things like infomedia, telecommunications, your public admin, and just your business services in general. They also saw some declines over the quarter, and I think it's good to point them out because what's probably driving some of this declines in those areas is still the labour market deteriorating. We know that total hours worked continues to decline, which is, put simply, if you've got less hours being worked, you've got less output coming out of these industries, right? And I think it's a good one to flag because, even though retail, trade and accommodation, they were up, those things can still also be kind of linked to the labour market, if consumer confidence starts to deteriorate, with the labour market also still deteriorating.
Yeah, I guess what I'm trying to say is that it was a positive print, but it is definitely not a guaranteed recovery from here. It's still very tentative, a cautious recovery from here. But 0.7 on the quarter, on an annual basis, how are things looking?
Yeah, so as you said, it's a good lift over the quarter, but I think we're coming from a very low base. I said we did have a cumulative 2.2% recession before this. Now the economy, if you compare it to December 2023, it's still around 1.1% smaller than it was then. So not as pretty, but that's just the story really of what we've been through with the high rate environment.
I think that just tells you how deep that recession was in that 6 months, that even though we had a positive print that was pretty strong, a 0.7 on a quarter is a strong print, that wasn't even enough to have us climb into positive on an annual basis. The other kind of indicator we do like to look at is per capita,
Yeah.
per person basis, because it kind of takes away all the noise of, population growth potentially driving your economy in that time. So taking a look at the per capita basis, it was kind of a similar theme to what we saw on the headline, right?
Yeah, exactly what I was going to say. Basically the same story. We had per capita output was actually positive, and we expanded activity on a per person basis for the first time in 2 years, which is incredible that it's taken this long. It's been a long time coming.
Yeah.
But then if you look at the annual number, we're still, that 0.4 just wasn't quite strong enough to get us out of this per capita weakness that we're seeing. I think we're still down around 2.2% on a per capita, per person basis, which, it's an improvement from last quarter's sort of annual decline, but we're still pretty much in the thick of it there.
Yeah. So I guess looking at it as a whole, whether on the headline basis or through per capita, it looks like we are past the bottom of this of the cycle, and we're actually on the up now. But again, it's very much a tentative recovery from here. I think households and businesses are still waiting for a bit more relief to come before they, expand in terms of consumption or in terms of investment. But we are, happy to see that positive print for the first time.
Yeah, for sure. And like you said, this is really old data. Like, it's so funny to actually think we're talking about the December quarter when we're pretty much coming up to the end of March. So I think it's enough of the last quarter, right? I think we can move on from that.
Yeah.
We covered everything about the last quarter.
I do like the GDP because it is, it has that completeness to it. Now I think we can put 2024 behind us, and now we can look at the more timely data that shows, positive signs for a turnaround this year.
Okay, so 2024, goodbye, finally. Okay, so what are we seeing in some of the data that's coming out for this year? Those higher frequency indicators that tell us more about current time.
Yeah, I mean, it's still quite mixed at best, but on balance, it does point to that tentative recovery from here. You have things like business confidence, which continues to improve since the Reserve Bank started cutting last August. But obviously, current activity is still quite subdued. You have PMI, so it's kind of a really good real-time indicator for economic activity. It looks into manufacturing specifically, but that for the first time in a long time is back into positive territory. That had been in contraction for a really long time. So those kind of high-frequency data do point to this recovery ahead. Also the housing market. I think in February it did relatively well. It had been kind of trading sideways, and it kind of is, but house prices are up 0.4%, which is pretty good considering how much stock is still in the market that we still have to clear. So there are signs of life in that space as well.
Yeah, definitely. But I guess it's still important to flag that this is, still below trend growth that we're expecting from here. We are coming, these green shoots that we're seeing emerging are still coming off quite a low base. So when do things start to really become normal?
I think we're still a few months from that. I think it's still very much a second half of the year kind of story, which is what we've been flagging for a while now. There are, encouraging signs of life here. Retail spend as well. If we look at our own Kiwibank transactional data, it is showing that households are kind of willing to open up their wallets again, probably going more towards sort of low value goods for now, just given interest rates are probably still quite a little bit too high for them, and they're wanting to rebuild their savings. But there are signs that they're opening up their wallets again, spending a little bit more. It helps that inflation is down and wage growth is surpassing inflation, so that real income growth is happening. So again, that's a positive for consumption.
But it is still very volatile. Consumer confidence, for example, had improved, but it really declined quite steeply in the last month's reading. So it's very much bouncing around. Again, any improvement is off a very low base. So that's kind of where we're at right now.
Yeah. And I think that kind of brings up, even though we do see this recovery from here, there are, headwinds that could disrupt momentum, the labour market being one of them. And then you've also got the global factors, which, again, we've talked about in almost every single episode since, I don't know, the start of the year. But, it is a risk that starts to feed through into demand for our exports, again, through either the tourism sector or even demand for our goods as well. So yeah, definitely a lot of things to watch, but I think it's very promising though, right?
It is. Yeah, I think it's just, this is, I think, the data we're looking at today. It's very indicative of a turning point. Our economy is reaching that turning point where some things are up, some things are down, but on balance, it does look like that recovery is slowly building, which is good news. And we do know that the Reserve Bank will deliver more. Well, we're expecting them to deliver more rate cuts this year, so that should just add more relief to households and businesses. One thing we're really looking at are those investment intentions, because that is really your source of economic growth. Once you see businesses actually expand and invest in new plant and machinery, that actually is a key source of growth. That's obviously very much tied to profitability, which has taken quite a big hit, but it looks like investment intentions are improving, but they haven't quite been acted upon just yet. But that's a very good indicator for us to keep an eye on.
Yeah. And just quickly touching, because you brought up the Reserve Bank, so probably good that we mention it. I had a couple of questions come through from some journalists, having that upside surprise going back to GDP. I know we said goodbye to 2024, but going back to that GDP number, that 0.7% lift over the quarter, because it was quite a bit stronger than what the Reserve Bank had forecasted. There were a couple of questions, asking, what does this mean for the path of interest rates? And I think we've already answered that by saying this is still off a very low base. If you look at the annual movement, that we're still, 1.1% smaller. And also the fact that we talked about, the volatility in the GDP numbers not having as much of a strong effect on the Reserve Bank in recent sort of discussions that they've had. I think they've even thrown out the term of dodgy GDP data. So that's good, though, because it means our outlook for, the path of interest rates hasn't changed. We're still expecting a 25 in April, a 25 in May, and then another step further, another 25 in the September quarter. So I think on balance, it was a really positive report, but doesn't change the outlook for interest rates right now.
No, I don't think so. They too were expecting an expansion. It's obviously just a little bit stronger than they had expected. The outlook for monetary policy is unchanged. For them, it's all about inflation. Inflation's at 2.2%. Looks like it'll stay around that 2% target in the medium term. So they just need to continue. I don't think this sways them in any way. Okay, I think that was a good episode, just going through all the industries and how we performed. Hopefully now we can really say goodbye to 2024. It was a very tough year for many businesses and households. Inflation is back at 2%, so that hard work, I suppose, is the result of that. But we are seeing now, if we look forward, signs of life in parts of the economy. Hopefully that spreads and we actually see our forecasts materialize, and we see that bounce back in the second half of the year. Obviously a few headwinds going forward, labor market being one, obviously the global backdrop being tumultuous as it is another one. But those aside, we should see the economy recover. It's been a tough one. But yeah, that's it for this week's episode. Join us next time.
If you liked what you saw or heard, be sure to follow, like, and subscribe, and we'll see you next time.
You've been tuned into This is Kiwi Economics, Markets, Mystics, and Mayhem. We'll be back next week for more analysis and insights.